My wife insists that American Express is the stock to buy right now. She said we can be rich buying the stock. I don't buy hype. So, I am going to do some study and not follow blindly. But, how do I start? The point here is to be rich. Maybe I need to study how much the stock can make me in 10 years' time. Let's do this by estimate how much is the company profit in 10 years' time. Since everyone in finance is telling me to use EBITDA, I am going to use EBITDA. For those who don't know, you can understand it as a type of profit. I will extract the data from stockanalysis.com. Think about it. Where do you think this number lands? Will the EBITDA be higher or lower? So in 10 years' time, based on the last 10 years, annual growth rate of the company, 11.4%. And assume the growth is slowing down year over year. American Express EBITDA will be $35 billion in 2034. Right now, people is buying the stock around 15 times the EBITDA. It means if a company now profit $1 a year, people will buy it with $15. In last 10 years, people usually buy the American Express stock with 13 times the EBITDA. As I personally think, dividend received is my profit too. I will be adding up the dividend I am getting in 10 years' time. So, to get the final price of the stock, I will be adding up 13 times the EBITDA plus the dividend. And the stock price is expected to be $746. Right now, the stock price worth $364, meaning I will earn 1 times my investments. Putting in $1,000 will earn around $1,000 in 10 years' time. Sounds like a bargain. But the finance people also says, best way of investment is to put in trust fund. To be rich, I would need to beat those giant S&P and QQQ. Similarly, I extracted the data from stockanalysis.com using S&P 500 stock growth in the last 10 years. I am assuming 10 years later, it will be 2.2 thousand, giving myself 2.6 times profit, and QQQ will be giving me 3.4 times profit. Now, in comparison, buying American Express stock sounds like a bad idea. Lower than QQQ. But hold up. After some research, they are saying cash is king. Do you think their cash performance can be better than the QQQ? All right then, I am using the same method. Estimating the free cash flow 10 years later, the stock price will ended up to be $1.2 thousand, meaning putting in $1,000 will be earning around $2.4 thousand in 10 years' time. Sounds like a bad idea. Lower than QQQ. I personally like dividend. Let's use the same method on dividend gain. The stock price will ended up to be $809, meaning putting in $1,000 will be earning around $1,000 in 10 years' time. Sounds like a bad idea. Lower than QQQ. Let's average all three methods, taking all consideration, and see how it goes. The stock price will ended up to be $926, meaning putting in $1,000 will be earning around $1.8 thousand in 10 years' time. Buying American Express can get us $1.8K, and QQQ is getting us $3.4K. Seems like buying QQQ is a better idea. Okay, the number seems terrible. But why? Let's study more about their business to understand more. Let's quickly break down the general information and the segment analysis. Starting from the general information. In short, so what are they doing? They charge merchants more. That pays for great rewards. It attracts the high spenders. They make money on interest and annual fees. Their history is wild. Started with freight forwarding, then the traveler's check, a game changer. Then the charge card, iconic the future. It's B2B payments. That's business to business. They are targeting millennials and Gen Z, and AI is key. They keep innovating their premium cards. It's all about high-value customers. Okay, I don't think that's enough. I know their story now. But how did American Express earn their money? Maybe we can understand it by knowing how the business earn. First, revenue by segment. To understand where is the revenue coming from, 68% of revenue by segment is from non-interest. 32% of revenue is from interest. Next, the CAGR of respective revenue by segment. To understand if these segments are growing well, or if there is any outlier on dip or growth, is 9% for non-interest, which is above benchmark, 19% for interest, which is above benchmark, In summary, the business exhibits a strong financial profile, heavily weighted toward non-interest revenue and demonstrating superior growth rates in both segments when benchmarked against industry standards. So, now we know the potential return and what the business is about. Is that enough to make an informed decision? That is not quite right. You see, buying a stock without checking the financials is like marrying a partner based only on their looks. It's gambling, plain and simple. If you've watched this far, you're serious about investing, and we need to run the numbers. To do that quickly, I developed a 22 checklist that pulls insights from the balance sheet, cash flow, and income statement. Running these 22 checks manually is tedious, so I use the fast download feature at stockanalysis.com to pull everything to Excel for calculation. This is the fastest way to get your insights. You can access the data and my recommended tools through the link below. Use the discount code STOCKSNACK. Starting off with balance sheet, we are checking 7 metrics. Out of the 7, we got 4 metrics with good score. So, let's talk about American Express. Their balance sheet is interesting. First, the good news. They are a cash machine. They generate cash so easily. More cash comes in than goes out. They can cover their liabilities. That is strong. That's solid. Now, we hit a strange spot. Their equity story is different. You want a company to fund itself. Use its own money, not just borrow. But American Express uses a huge amount of debt. Too much debt, actually. Their self-financing ratio is way too high. It means they rely heavily on outside money. That's not ideal long-term. But here is another positive. They don't need special investors. No need for preferred stock. That funding source is clean. That's good. And the growth, it's consistent. They keep growing their retained earnings. Even during tough economic times, that 10% growth rate is reassuring. It shows real business resilience. Now, a confusing signal. Share buybacks, they don't aggressively buy their own shares. They're not shrinking the share count. That's usually a missed opportunity. Investors like that signal of confidence. American Express just doesn't send it. Back to performance. The return on equity is excellent. They are very efficient with shareholder money. It's clearly above the benchmark. That means the core business is highly profitable. But the final view is mixed. Look at the return on total assets. ROTA is how well they use everything. Every building, every machine, every dollar. That metric is very low. It's a weak point. It says they could be far more efficient. They have to put so much money to work just to generate a small return on those total assets. So, American Express is a cash-generating giant. They are profitable for their owners, but they carry too much debt, and they are not asset efficient. That's the takeaway. That's the story. Next is income statement. We are checking 9 metrics. Out of the 9, we got 5 metrics with good score. First, the big win. Pricing power is absolute. Their gross profit margin is phenomenal. They essentially keep every dollar of revenue. It shows their premium brand works. Merchants pay up. Customers pay fees. They control the price. That is a massive strength. But then we hit a snag. Look at selling expenses. It costs them a lot to sell their product. SG&A is too high compared to their profit. This is the cost of all those rewards. The fancy lounges, the aggressive marketing. The card does not sell itself. They have to spend heavily to acquire and retain customers. That's a big operational drain. However, the business is simple. No complicated factories. No massive product labs. R&D costs are basically zero. It's a financial service. That's efficient. Next, their debt payments. Remember, we said they carry a lot of debt. But the interest expense is not a problem. It's tiny compared to their operating income. The business is so profitable. It easily covers the interest bill. The debt is manageable, despite the size. A quick note on taxes. They pay more than the target. Their effective tax rate is slightly higher. Nothing alarming, but it's above 20%. They pay their fair share to the authorities. Now, final profit margins. Net income to revenue is below the benchmark. It's not as high as you might want. It suggests the competitive advantage is not translating to massive final margins. All that heavy spending the SG&A eats into the bottom line. But the actual earnings per share is fantastic. It is growing consistently, year after year. The growth rate is strong. It beats inflation easily. That is the true signal of long-term value. They deliver for the shareholder. Finally, a reality check on debt. The payback period for their debt is slow. It would take over 5 years of current earnings just to pay off the total debt. That is a high number. It means they are leveraged. The debt is manageable, yes, but it is significant. That is a risk to watch. Next is cash flow statement. We are checking 6 metrics. Out of the 6, we got 4 metrics with good score. Okay, final section. We look at where the cash is actually going. This is the cash flow and capital analysis. First, stock compensation. This is a good sign. American Express is not aggressively diluting shareholders. They are not giving away too much free stock. The ratio is low. That's a huge positive for investors. The management pay structure is healthy. Now, a big problem. Look at the earnings quality. The net income number is misleading. It's much higher than the actual cash they generate. Operating cash flow is lower than net income. This means the reported earnings are not translating directly into physical cash. You call this low earnings quality. That's a red flag. And it gets more complicated. Look at free cash flow. The growth of cash is lagging behind the growth of profit. The overall cash growth is just too slow. It's much slower than the net income growth rate. This confirms the previous point. Something is soaking up the cash. The high profitability on the books is not reaching the bank account fast enough. Let's check the spending. Capital expenditures are low. That is excellent. They don't spend much on buildings or equipment. They have a light asset base. This leaves more cash available. That's very efficient. Finally, where does the excess cash go? They pay dividends. They buy back some stock, but they spend less than half of their free cash flow on that. This is exactly what you want to see. It means over half of the company's real cash is being retained. It can be reinvested in the business. They use the money for future growth. That shows responsible capital allocation. So, the cash flow story is mixed. Low spending and low dilution are great, but the quality of the earnings is questionable. Cash is lagging behind profit. That's the critical observation. The combined financial score is good, 13 metrics with good scoring out of 22 metrics. Now, it is time to make the conclusion. So, is what my wife said correct? Will I lose money buying American Express stock? By the profit-wise, buying QQQ or S&P 500 is having more potential than American Express. However, it is having a good financial health. It's a stock worth monitoring. Now, the analysis is complete. Once again, if you needed tools for your investment strategy, give a try to stockanalysis.com. They provided sufficient free tools for you to work around. If you ever want an upgrade, promo code is StockSnack. Institutional grade data with less than $1 a day. One day, one stock. See you again at StockSnack.